I want us to look at leases. We're going to look at leases. Leases. So the first question in this case, I want you to open August 2025. Question number 5. Question number 5, August 2025, question number 5, additional information number is additional information number 3. Additional information number 3. So once you are there, you can say yes. Once you are there, you say yes. Once you are there, you say yes. Once you are there, you say yes. I can see James is saying no audio. You should be able to check his end. So I can see PC says yes, you are there. August 2025, question number 5, additional information number 3. We are looking at leases. We are revising leases. Look at August 2025, question number 5, additional information number 3. So are you there? So only one person is there. That is quite surprising. So at least 2 or 3 or more people should be able to confirm. Bonita says yes. Bonita says yes. He is there. Can also be able to see Dan Josh says is there. So this is what in this case, this question was for published financial statements. The question was for published financial statements, but what you have to take note about questions about published financial statements, they'll always be able to borrow from the other areas you've been able to learn. So they can be able to put leases, they can put income taxes there. So mainly this one has become very common. They will mix leases with published financial statements. So, and of course, we know under leases, you're supposed to know the right of use of the asset, the depreciation. You're supposed to know, in this case, the non-current liability obligation, the current liability obligation, the interest. Then, of course, you have to be very keen. You have to take note whether the lease payments are having to be done in arrears, or in this case, the lease payments are having to be done in advance. The lease payments are having to be done in arrears, or they're having to be done in advance. So for this question, that note number 3, wanted us in this case to do some computations there regarding leases, so that we can be able to identify all those elements. So if you are there, of course, you are preparing financial statements for, in this case, the year ended 31st of March. We are preparing financial statements for the year ended 31st of March, 31st of March 2025. This is the end of the year. And this is what you are told about that additional information. On 1st of April 2024. So on 1st of April means it was the start of the year. When this financial year started, is when they list that item. So on 1st of April 2024, Flex Limited acquired an item of plant under a lease agreement that had an implicit interest rate of 10% per annum. The lease payments in the trio balance represent an initial deposit of 2 million paid on 1st of April 2024, and the first annual rental payment of 6 million paid on 31st of March 2024. So the lease agreement requires further annual payments of 6 million on 31st of March each year for the next 4 years. So the lease payments in the trio balance represent an initial deposit of 2 million paid on 1st of April, and the first annual rental payment of 6 million paid on 31st of March 2025. The lease agreement requires further annual payments of 6 million on 31st of March each year for the next 4 years. The plant was initially measured at 25 million on 1st of April 2024. So this lease, is it the lease payments, are they having to be done in arrears or in advance? If you look at it, are they in advance or in arrears? If you look at it, look at that additional information. These lease payments, are they having to be done in arrears or in advance? I can see Nancy says advance. Can see Nancy says advance. So I can see PC says arrears. PC says arrears, or Lango says arrears. Can see Nancy says advance. So there's something in this case I told you about questions. You have to be very keen about the dates. Never ignore when you see a date has been indicated somewhere. Be very keen. Be keen with that date. Concentrate with it. Focus with it. That date. What is it having to mean? So these ones are in arrears. They're in arrears. So if you look at that statement there, there's a statement that has actually been given there. Is it the second sentence? The lease payments in the TIO balance, there's an amount of 8 million. If you look at the TIO balance, the TP, because you're not focusing there, but you can focus there for this amount. In the TIO balance you have in that question, there's an amount of 8 million, which is on the debit side, which is an expense they incurred in terms of this lease. So this amount of 8 million you're having to be told, it includes an initial deposit of 2 million. So there was an initial deposit of 2 million, which was paid on this debt. They paid 2 million. Immediately in this case, they commenced using the asset. They had to pay a deposit of 2 million. They had to pay a deposit of, in this case, how much? 2 million. A deposit of 2 million. Then there's another 6 million they paid. And the first annual rental payment of what? 6 million paid on 31st of March. So on this debt, they paid 6 million. So of course, when they started, there was an initial deposit of 2 million. But at the end of the year, they were paying what? 6 million. They paid in this case what? 6 million. So this was the agreement. They put in something like 2 million, then they paid 6 million subsequently. So in this case, they paid 6 million at the end of what? The year. So this basically is exactly what? These are lease payments in arrears. They're having to be done in arrears at the end of each and every period. Because in this case, this is what you're having to be told there. This amount represents a deposit of 2 million on 1st of April and a first annual rental payment of 6 million paid on 31st of March, which is the end of the year. The lease agreement requires further annual payments of 6 million on 31st of March each year for the next, in this case, how many years? 4 years. The lease agreement requires further annual payments of 6 million on 31st of March each year for the next 4 years. The plant was initially measured at 25 million on 1st of April, 2024. 2024. 2024. So what is the lease period here? What is the lease period? What is the lease period here? If you look at that question. What is the lease period? The lease period is how many years? 5 years. You are the most brilliant students I've met this year. You are the most brilliant students I've met this year. If you can identify that, you are the most brilliant students I've met. It is actually 5 years. It is 5 years because they had made 6 million, but now for the next, there'll be other 4 payments that will be made. So it basically totals to how many years? 5 years. It totals in this case how many years? 5 years. It totals in this case how many years? 5 years. And then in this case, you are told the plant was initially measured at 25 million. So you've already been given the fair value of, in this case, what? The plant. Plant and equipment and other things in this case, so those ones which they won't matter. So we want in this case to deal with the lease. So in this case, anything to do with the leases, in this case, you must never forget. So there are these key things that you must be able to identify: the fair value of the lease liability, fair value of the lease liability, the right of use of assets, the depreciation, the non-current liability obligation, the current liability obligation, and the interest. So these key figures, you must actually be able to get them. You must actually be able to, in this case, to do what? To get them. You must actually be able to get them. So of course, in this case, when they give you in the question in the fair value of the asset, when they give you in this case in the question the fair value of the asset, basically in this case, that will be able to represent what? The right of use of the asset. So they can give you the fair value of the asset in the equation. This is what the examiner has gotten used to having to do nowadays. He'll be able to give you, for example, in this case, then you've actually been given a value of, in this case, 25 million. You've been given a value of, in this case, of 25 million. So we can have, in this case, our figures having to be in thousands. Let's have our figures in thousands. You've been given the fair value of that asset as having to be 25 million. So that, in this case, will happen to be what? To be the right of use of the asset. It will happen to be the right of use of, in this case, what? The asset there. It will happen to be the right of use of the asset. It is the fair value of the asset. Is the fair value of, can we say fair value of the lease? Fair value of the lease. It's the fair value of the lease. You've actually been given, in this case, what? 25 million. But maybe you can be able to say this. So the right of use of the asset, is equals to fair value of lease liability. Fair value of lease liability. You add on any initial direct costs. Any initial direct cost that was actually, in this case, incurred. Any initial direct cost that was actually, in this case, incurred, or initial payment. You can maybe say initial direct cost or payment that was done. Any initial direct cost or payment that was actually, in this case, done on this asset. So overall, in this case, the right of use of the asset there we are having. So this one, you've been told they paid what? 2,000. They paid 2,000. They actually paid 2,000 there. Then the right of use of the asset here simply means is actually an amount of what? It is 25 million. 25 billion. So it means the fair value of the lease liability, it will be the difference. In this case, it will likely be 23 million. 23 million. Because the fair value of the asset, the fair value of the asset you've actually been given, the fair value of the asset you've already, in this case, been given there, as having to, in this case, be what? 25 million. It is 25 million. So in this case, that will be able to represent what? The right of use of the asset. So to get the right of use of the asset, we normally take the fair value of the lease liability. We add on any initial direct cost, or in this case, what? Payment that was, in this case, done. So that is what they're having to get as what? As a total of, in this case, 25 million. But of course, this one you can be able to compute. You can be able to compute. So you can take, in this case, for this one, you can be able to take the rental payments. You can take the rental payments. You multiply by the present value interest factor of annuity, considering a particular rate, by, in this case, what? Number of years, by considering a number of, in this case, what? Years. So let's try to do it and see what is having to happen. So the rate of payments you've actually been told it was, in this case, 6 million. So we multiply, in this case, by 1 minus 1 plus 0.1 raised to, in this case, what? -5 over 0.1. So try to do this computation and tell me the figure. Try to do it and tell me the figure. Try to do it and tell me the figure. So try to do that computation and tell me the figure. So 6 million multiplied by 1 minus 1 plus 0.1 raised to -5, because it is in arrears. So we'll do 5 here. We'll do 5 years or 5 periods. You're getting how much? You're getting 22. Lango is 22,744 around there. 22 around that there. 22,744. So assuming you are not given this figure here, if you put 22,744 here, you add it to, you'll get, in this case, what? 24,744. So what the examiner did, he rounded off. They will round off and actually give you the nearest thousands. So he rounded off. But in this case, if it is, the examiner hasn't given you this, you can still be able to calculate. So to get the fair value of the lease liability, which is the first computation you must actually be able to do, the fair value of the lease liability, you take the rental payments multiplied by the present value interest factor, considering the rate and the number of years or periods, then you should be able to get the fair value of the lease liability. To get the right of use of the asset, you take the fair value of the lease liability, you add on any initial direct cost or payment that was done. And in this case, it was actually what? 2 million. So in this case, we had 22,744 here, add to, you'd have gotten 24,744, but the examiner just rounded off and gave you the figure. So it means the right of use of the asset is what, in this case, you've already actually been given by what? By the examiner, which in this case is actually what? 25 million. Which is actually, in this case, what? 25 million there. 25 million there. But if you haven't actually been given, still you can be able to calculate this fair value of the lease liability. Then you add on any initial direct cost, then you can be able to get the right of use of the asset, right of use of the asset. So that in this case, what is having to happen there. So remember, it is in arrears, we take all the 5 years here. We take all the five years here. If it's actually in arrears, we take in this case what? All the 5 years there. We take all the 5 years there. If it's in arrears, we take all the 5 years. If it's actually in arrears, we take what? All the 5 years. And therefore, with this, because you've already been able to get this, so you've already been able to get this, we have this. So there's depreciation. So in this case, to get depreciation, you will take in this case the right of use of the asset, divided by the useful life. Useful life, you can take the useful life, or you can take, sometimes they might be silent, you can take the lease period. They won't give you a useful life, but they'll give you the lease period. Take the lease period. So in this case, for example, in our question here, have they given us the useful life? Oh, so you are told on 1st of April, acquired an item of plant that had an implicit interest rate of 10% per annum. The lease payments in the tier balance represent an initial deposit of 2 million paid on 1st of April, and the first annual rental of, in this case, 6 million paid on 31st of March 2025. The lease agreement requires further annual payments of 6 million of this. The plant was initially measured at 25 million on 1st of April. We haven't actually been given. So we take the lease period, which in this case is actually what, 5 years. So in this case, it means it will actually be 25 million, or in this case, what, 5. So in this case, it means for each and every year is having to lose how much? 5 million. It is losing in this case what, 5 million in terms of what, depreciation. So if they haven't actually given you the useful life, you take the lease period. If they give you both of them, take the lower. And of course, obviously the lower is normally the lease period. The lower is normally the lease period. If they give you the 2, take the lower of the 2. In most of the instances, obviously the lower will be the lease period, because you cannot lease an asset which has a lower useful life than the lease period. You'll actually basically be the most useless financial manager. The most useless financial manager, because how do you lease an asset for a period that is more than the useful? It can never happen. So you can either have a lower lease period and a more what, useful life. So you have sometimes they can give you both. So if they give you both, take the lease period. Take the lease period, take the lease period, take the lease period to calculate what? Depreciation on the right of use of what? Of the assets. But if the examiner is also silent, in this case, he hasn't given you the useful life, take the lease period you've actually been given. Like in our question here, the lease period is 5 years. So we'll be able to calculate depreciation by taking the right of use of the asset over the number of years. So that's what in this case you have to take note of that. So already in this case, you have the right of use of the asset, we have the depreciation. What is remaining is these 3 elements. We in this case need to be able to come up with what? An amortization schedule. And in this case, what you have to take note of in this case, in the amortization schedule, we are looking at in this case what? The lease liability. So hope it is okay. So it means in this case, what is still outstanding at start is actually in this case how much? 23 million. So in our amortization schedule, we'll start with this amount. We'll start with this amount as what? As the lease. This is what has not been paid. You know what it means, a liability. But when you're commencing the lease, this is what has not been paid. So you'll have to take 25,000 minus the initial deposit. We get what is still outstanding when you are commencing the lease, which in this case is how much? 23 million. Assuming we were using what we calculated, we would have used this figure. We would have used that figure. But now we are having to use what you've been given by the examiner. So you take what he has given you as the fair value of the asset, deduct any initial payments. If there was no initial payment, it means in this case, the fair value of the lease liability would have been the entire amount, which in this case would have actually been what? 25 million. So we can go in this case to the amortization schedule and see what was, I can see. Was this 23 million or 25 million? I don't know what you mean by that, Nancy. What are you asking about? The right of use of the asset, or in this case, the or the fair value of the lease liability. So we can come up with the amortization schedule. Let's come up with the amortization schedule to get the three other elements. So that is the non-current liability obligation. And in this case, what the current liability obligation. So the amortization schedule. So it will look like this. So we can have the period. Remember, this one is in what? In arrears. So we start with the period. We have the balance brought down. Then interest is charged immediately. Which is at 10%. Then after interest is charged is when now they make a payment. When they make a payment, there's the principal amount they are settling. Then there's, in this case, what the balance carried down. So because our shillings are in thousands, like that. So we have in this case 5 years, but of course, for this question, you would have only been able to do for 2 years. For this question, if you are dealing with this question, you would have only been able to do for 2 years. So we have 5 years, but we can just be able to do for all of them. Yeah, so in this case, we have 23 million. So is our lease liability. Remember, this is what is owing when you're having to, in this case, do what commence. It is 23 million. So the interest in this case is actually 10%. So we charge interest of 10%. Then the payments that are having to be done is actually 6 million. This one is constant. They are making payments of 6 million. This one is constant. So when they make a payment of, in this case, 6 million, there is an element of the principal amount they are settling of how much? There's an amount of the principal which they are having to settle of how much? When they make that payment of 6 million, there's an amount of the principal which they are having to settle of how much? When they make the payment of 6 million, there's an amount of these they are settling. Of course, they clear the interest. Then in this case, there's an amount of this principal they are having to pay. $3,700. So in this case, it is 3,700. Then we deduct. So we deduct from this. Is it 19,300? They are paid this principal amount. So this comes here, the opening balance. We take 10%, 1930. So 1930, 6 million minus 1930. 6 million minus 1930. Let me put a charger on my laptop. The initial amount is the principal amount. So you get 15 something. 15. So 19,300 minus 4070. We get 15,230. So 15,230. So we bring it here, 15,230. 10%. So in this case, it comes to 15,23. So 6 million minus 15,23. 6 million minus 15,23. 6 million minus 15,23. You get 44,77. So 44,77. So we deduct 15,230 minus 44,77. You see what is the balance carried down. So 15,230 minus 44,77. You get 1075.3. So 1075. Oh, it is here. It is what? 10,753. So 10,753. 10,753. So 10,753. So 10%, it is 1075.3. We deduct 1075.3 from 6 million. So you get what? You get 40 something. You get 40. 1075.3. So we deduct from 6 million. We want to know the principal amount, how much. When they pay this 6 million, they are clearing this interest plus an amount of this. So this amount of this is what we want to know. What were they paying? So they were paying how much? 4924.7. 4924.7. So you deduct 10,753 minus 4924.7 minus 4924.7. You're getting 5828.3. 5828.3. So we come here 5828.3. So 10% you'll get 582.83. So you deduct. Just deduct. So 6 million minus 582.83. You get 6 million minus 582.83. You get 50 something, 54 something. You get 54. You get 54 something. 54 what? 5417.17. 5417.17.17. So when you deduct from this, you get something like 300 and something. 400 or something. 400 and something. So deduct from this 5417 from this, you get 4 something. 400 and there's a figure you put together. 411.13. So 411.13. So they should basically it should actually be 0. But now you know what happens. You know this figure is actually rounded off. That's why you will not get a 0 there. But let's assume we were using that correct figure, we are getting that 22 something, 22,400. Was it 22,700 and something? So if you put that figure here and you work through, you'll come to close to 0 here. It should be close to 0, or it should be barely, in this case, be 0. But because of the rounding off by the examiner, then you want to be able to get an exact 0. But this is how, in this case, you prepare the schedule. So from this, then now you can be able to get the interest. And remember, you know, for this question, ideally you would have just done up to here. I've only done up to the end, but if you're in an exam situation, you are dealing with this question, your interest would have ended here. Your interest would have ended here because they want you to prepare the financial statements for the year ended 31st of March 2025. And of course, the start of the year is actually the start of the period, 1st of April 2024. So we've done in this case for 2026, we've done for 2027, we've done for 28, and we've done for 29. So the main focus would have been for you to just do this schedule up to here. So don't go this side, because if it was this question that you are dealing with, that published, because they want you to know the non-current liability obligation for the year ended this, and the current liability obligation for the year ended this, and also the interest only for the first year. So in this case, the interest for the first year, you would have picked this figure. So this figure would have gone to the income statement as what? As a finance cost. So the finance cost here would have actually been this one. The finance cost would have actually been that one. Then for the non-current liability, you would have in this case taken the balance carried down from, in this case, what? The second period, which in this case is having to come to 15 to 30. Is it 15 to 30? Yes, 15 to 30. You would have picked that 15 to 30. So in this case, for the non-current liability obligation, you take the balance carried down from second year. While in this case, for the current liability, you take the principal amount from second year. This is how you deal with what? Leases, that in this case, you're having to make payments in arrears. So in this case, you would have taken the principal amount from, in this case, what? The second year. So it means in this case, for the current liability obligation for the statement of financial position, you pick this figure. While in this case, the non-current liability obligation, you pick what? You pick this figure. You pick that figure. You pick that figure. You pick that figure. Again, it is this figure having split into two. It is actually split into the current and the non-current liability obligation. But if you have the schedule, basically in this case, this is how you pick what? The non-current liability obligation. You take the balance carried down from the second year. So this one will represent for the first year, while this one will represent for the second year, while this one will represent for the fourth year. So here it is basically zero. It will be zero in this case. So it means if you want to know the non-current liability obligation for the second year, you pick this amount. If you want to know for the third year, you pick this amount. So the non-current liability obligation. If you want to know the current liability obligation, you pick the principal amount from the second year. So it means for the first year, you'll pick this amount. For the second year, you'll pick this. This will represent the current liability obligation in the statement of financial position for the second year. This one will represent for the third year. This one will be able to represent for the fourth year. It will represent for the fourth year. So this is a statement you must actually be able to master. The non-current liability obligation under, in this case, lease payments in arrears. You take the balance carried down from the second year. While in this case, for the current liability obligation, you take the principal amount from the second year. You take the principal amount from the second year. You need to take note of this. You must be able to master it. If the lease payments are having to be done in arrears, for the non-current liability obligation under the lease, you take the balance carried down from the second year. While in this case, if you're having to look at the current liability obligation for lease payments in arrears, you take in this case what? The principal amount from the second year. You take the principal amount from the second year. The principal amount from the second year. So that's what in this case is having to happen there, is happening there. We can look at another one. Let's look at another one. So that was in this case what? That was August 2025, question number 5. So let's look at another one. You can open this other one. Open December 2024, question number 4. December 2024, question number 4. So December 2024, question number 4. So once you are there, you tell me you are there. December 2024, question number 4. December 2024, question number 4. So December 2024, question number 4. Question number 4. Look at additional information number. Look at additional information number. Additional information number 3. Additional information number 3. Yes, additional information number 3. Additional information number 3. So if you are there, you say yes. I can see PC is already there. PC is already there. PC is already there. PC is already there. I can see Nance is already there. Dan is already there. Dan is already there. So that one, I want us to move now very quickly. That one, I want us to move now very quickly. You know, it is almost 2 p.m. It's almost 2 p.m. People have other issues. So for this one now, the lease payments are actually in what? In advance. If you look at what you've been told there, On 1st of November 2023, which is the start of the year. So that 1st of November is the start of the financial year of this company. Because you can see we are preparing financial statements by the end of 31st of October 2024. We are preparing financial statements by the end of October 2024. So this is the start of what the financial year. This is when they list the assets. So you are told on 1st of November 2023, Farmland Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which was payable in advance with effect from 1st of November 2023, was 22 million. The fair value of the plant is 92 million, and the implicit interest rate is 10% per annum. Is 10% per annum. Exactly in this case, what? 10% per annum is 10% per annum. So in this case, just the same case, we are supposed in this case to know the fair value of the lease liability, the fair value of the lease liability, the right of use of the assets, then in this case, the depreciation, then the non-current liability, the current liability, and of course the interest. Because in this case, what the interest, all those ones must actually be determined here. Must actually in this case to what be determined here. So for this one now, in this case, the lease payments you'll be told they're having to be done in what? In advance. So they were payable in advance with effect from this debt. They were payable in advance from effect of that particular what? Debt. So of course you've actually already been given what? The right of use of the asset or the fair value of the asset, which in this case is exactly what? 92 million. Exactly in this case, 92 million. So the fair value of the asset, so the fair value of the assets, which is the right of use of the asset, is actually what? 92 million. So you can still have our figures having to be in shillings of thousands. But now in this case, assuming you are not given this figure, here, so you could have taken in this case the rental payments. So the rental payments multiplied by the present value interest factor of annuity at a particular rate by what? The number of years. So what you've actually been given there is rental payments of how much? 22 million, which started from 1st of November. So we'll take 22 million multiplied by 1 plus 1 plus the rate is exactly what? 10%, or is 10%. 0.1, but now the period here, you will take -4. Don't take in this case the entire 5 years, because there was an initial payment which was done. Don't discount that one. Don't discount the initial payment. Discount the subsequent payments in future, 4 of them in future, because the initial 6 million was already received when they were commencing. You don't discount, it's already in the present. You know, this is discounting, getting a future value to the present. So don't discount what is already in the future, what is already in the present. Discount only what is actually in future. There are still 4 payments remaining in future when you are commencing the lease. So that's why we take what? Only 4 periods. Don't take 5 periods, because the payments are being received in advance. When you are commencing, already 1 payment has been received, is already in the present. Don't discount it further. Discount the 4 subsequent ones in future. So what are you getting? There's a figure you'll be able to get here. You are getting how much? Should be able to get a figure there. Nancy, what are you getting? 22 million by that. Is it 1 plus or 1 minus? Is it 1 minus or 1 plus? It's 1 minus. Into minus. I'll put plus. And you're not telling me I'll put the wrong thing. It is 1 minus that. Supposed to be 1 minus. Yes, you can do the calculation now. Do the calculation. It is supposed to be 1 minus. That is the formula. It is 1 minus, not 1 plus. You get 69,737. So 69,737. So assuming you are calculating the right of use of the asset. So right of use of the asset is equals to in this case, fair value of the lease liability fair value of lease liability, which you've gotten here, which in this case is exactly what, 69,737. Then you would have added on an initial payment. Added on an initial payment of, in this case, how much? 22 million. You would have added on 22 million. So in this case, you'll get 91,737. So what the examiner did, he just rounded off to the nearest. He rounded off to the nearest and he gave you the figure. But if they don't give you, this is how you're supposed to calculate. These are according to the standard. This is how you calculate. This is how you calculate in this case what? The fair value of the lease liability. Then in this case, you get the right of use of the assets by taking the fair value of the lease liability, add on any initial payment or initial direct cost. You should be able to give you the right of use of the assets. The right of use of the assets. So now that in this case, he has rounded off, he has given you, then we can now just be able to use this figure. Don't use this one, but if you are denied, you can actually be able to use that. So in this case, you can be able to calculate now, in this case, what's the depreciation. So we've been told the useful life of this asset is how many years? The useful life of this asset is how many years? So this item had an estimated useful life of 5 years, and the lease period is also what, 5 years. Therefore, you can be able to get what, the depreciation. You can easily be able to now do what, the depreciation. So you can go to the second part there and actually be able to get the depreciation, which in this case will likely be what, the right of use of assets. Right of use of asset over the useful life, or in this case, the lease period. So in this case, take 92 million divided by 5. What do you get? 92 million divided by 5. 92 million divided by 5. We take 92 million divided by 5. You get 18,400. 18,400. 18,400. Yes, you get 18,400. So this 18,400. What this one means, when you'll be taking this asset to the statement of financial position in that question, you should be able to take 92 million minus this. Because this right of use of the asset is reported as an asset in the statement of financial position. Because that is part of what you've been told to come up with there as the final statements. When you come up with your final statements, you need to take this 92 million minus this to get, in this case, the net book value of this right of use of the asset. Right of use of the asset. So we've already been able to do what? Identify this. We've identified this. What is remaining is this 3, which means you have to come up with what? An amortization schedule. You have to come up with an amortization schedule. So we can be able to come up with it very quickly. Very quickly. So hope you've been able to write this because I'm wrapping. I'm wrapping to come up with the amortization schedule. Come up with the amortization schedule. So the amortization schedule in this case, if the payments are having to be done in advance, looks a bit different. Is a bit different. So in this case, you'll have the period. Then the balance carried down, brought down. Then payments are coming immediately. So the interest doesn't come fast. Payments are coming immediately. Then once you make the payment, there's a balance due. There's a balance due. Then on this balance due is when now we charge what? Interest. Is when now we charge interest. Then after that, we'll have the balance carried down. Balance carried down. So we can have, in this case, these ones represented in shillings of thousands. This one is represented in thousands. So we can have, in this case, it is for 5 years. But we know for the question here, you wouldn't have done up to 5 years. You would have only been able to do up to what, second year, because our interest is just what? For these elements for the first year. So you don't have to go to up to 5 years. But if you are doing this question that you are looking at, if you probably in this case you are handling this question, you shouldn't have actually gone to 5 years. You just go up to second year because these elements can be identified from the second year. Can be identified from the second year. You don't have to go to 5 years if you are doing that question. But let's do and just complete it. Let's do and just complete it so that you get the concept. The essence is to get the concept of leases. The essence is to get the concept of leases. The essence is to get the concept of leases. The concept of leases. the concept of leases. What will be our balance brought down? Who can be able to tell us our balance brought down? What will be our balance brought down to start with? Who can be able to tell us the balance brought down to start with? 𝗂𝐿. What will be our balance brought down to start with? What will be our balance brought down to start with? So 69,737. Of course, it is 69,737, but 𝗂𝐿 now, you know, the examiner had alikuwa amefanya mambo yake. Yeah, alikuwa amefanya mambo yake ameweka 92. So itakuwa 70. It will be 70. You will take that 92. You minus what has already been paid initially. So we are starting with a liability of 70. When you are commencing the lease, there's a liability of 70. So it is not that 69. But if you had done our question by ourselves, we would have used that 69. But now it is the examiner. He did his thing. Don't start with the 92. Christian, don't start with the 92. Start in this case with what? 70. 70 is what in this case is still outstanding. Then remember already the first payment has been done. So don't put there anything. You only have the subsequent 4 payments having to be done. In this case, 22 million. 22 million. You have to be very keen with this schedule, how it is having to look. It is a bit different. So here, don't put anything because already the initial payment was received there. So we are starting with a balance due of, in this case, 70. Then in this case, we charge interest of 10%. So it comes to 7,000. It means by the time you're having to close the year, we take the balance due plus the interest. It is having to come to 77,000. We bring it here, 77,000 minus 22, you get 55,000. 55,000, 10%, you get 5,500. 5,500, it comes to 60,500. It becomes correct. You bring here 60,500. You pay 22. You'll have a balance due of how much? 48. 42 or 38, 38,500. You take 10%, you'll get 38,50. You add, so you get 41 or 42. 38,500 plus 38,50. 42,350. You get 42,350. You bring this one here, it is opening here, 42,350. You minus 22, you get 20,350. You take 10%, it will come to 20,35. 20,35. You add 22,385. 22,385. Yes, 22,385. 22,385. You bring it here, 22,385. 22,385. You minus 22. Ideally, it is supposed to remain 0 here. So you'll have like a figure of 385. Because of that rounding off, you'll have this figure remaining here, but it is supposed to be 0. You would have already been able to complete once you make the final payments. But because of the rounding off by the examiner, then there's that problem there, but you're supposed to be able to remain with 0. You're supposed to remain with, in this case, what? 0. So you'll, in this case, for example, if you are doing this question, you're having to say your main focus would have been able to end here on the schedule. Would have been able to end here on the schedule. So for the interest, you would have picked this figure to go to the income statement, which is the interest. Then, or in this case, payments in advance, for payments in advance, So the non-current liability, you'll in this case take the balance due from the second year. Balance due from second year. So the non-current liability obligation will take the balance due from, in this case, what? The second year. So it means in this case, the balance due, it is this one. So this one will be able to represent the non-current liability for the first year. This one will represent for the second year. This one will represent for the third year. This one will represent for that one there. Then for the current liability, you will take in this case the principal amount. You will take the principal amount. Not the principal amount, but in this case, what? The payment. You take in this case the payments. You take the payments from the second year. Payments from, in this case, what? The second here, the payments that were done from the second year. So the payments from the second year, in this case, represent what? The current liability. So this one will be for this one. So this one will be for this one. So it means you pick this figure here, you pick this figure, and of course this figure. So this will be the non-current liability, while this one will likely end up having to be the current liability. So for the NCL, you take the balance due from the second year, the balance due from the second year. For the CL, you take the payment. It is a payments in advance. For payments in advance, for the current liability, you take the payments that were done from the very second year. So it means these will go here, these will go here, these will go here, these will go here in your statement of financial position. So you would have actually been able to pick these three figures here to help you solve this question. This one, and this one. So this one would have gone to the income statement. This one would have gone to the statement of financial position plus this one. This one as a non-current liability. This one as a current liability under the lease. Current liability under the lease. So that's why in this case you deal with what? Leases, where payments are having to be done in advance and payments are having to be done in arrears. It's a concept you must actually be able to master, because now in this case, you'll never miss it. Nowadays, you rarely miss it in published financial statements questions. And if you don't know how you can be able to deal with leases, then so they can test it as a standalone question, or they can bring it under what? Published financial statements. So they can test it as a standalone question, or they can bring it under published financial statements. If a standalone question, then being able to see, you can be able to deal with it like that. So you need to come up with a statement of what? Income statement extract, statement of financial position extract. But of course, those ones we've already learned in class. So I think I'm going to end there. I'm going to end there unless there's any burning question you can be able to ask. But let me end there for now. 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 Any question? Any question? No question. So let's end there for now. So enjoy your weekend. Enjoy your weekend. We catch up later.